The anatomy of a perfect trap. Imagine standing on the edge of a cliff, fully aware that a single misstep means disaster. Your senses are sharp. Your focus is absolute. You respect the danger, and because you respect it, you survive. Now, imagine walking through a beautiful, flat meadow. The sun is shining, the path seems clear, and you feel completely safe. You let your guard down, you stop looking at the ground, and right there, hidden beneath the grass, is a trap. In the financial markets, most people assume that their greatest enemy is failure. They think a brutal losing streak is what destroys a career, but they are looking at the wrong threat. The most dangerous moment in your trading life isn't when you are losing, it's when you can't seem to lose. It is the winning streak. When you lose a trade, your brain treats it as a threat. It triggers a state of high alert. You analyze your mistakes, you tighten your risk management, you pay close attention to the details. Pain forces focus. When you win 3, 4, or 5 times in a row, a completely different chemical process takes over. Your brain floods with dopamine, the hormone of reward and anticipation. This creates a state of cognitive euphoria. In this state, your perception of risk doesn't just decrease, it completely vanishes. You begin to believe that the market is easy, that your strategy is flawless, and that you have somehow mastered the chaos. This is where the illusion begins. You aren't actually mastering the market. You are just experiencing a temporary alignment between your random choices and the market's random movements. But the euphoric brain cannot see randomness. It only sees its own genius. And that is exactly when the trap snaps shut. The horizon before the storm. There is a strange, quiet period that occurs right before a massive structural shift in any system. Geologists notice it before earthquakes, the ground settles, and animals go silent. Meteorologists see it before a major storm. The wind drops completely, creating an eerie, calm atmosphere. The exact same phenomenon happens in the financial markets, but it doesn't manifest on a chart. It manifests in human behavior. When a market is reaching the absolute peak of an unsustainable cycle, the crowd doesn't get nervous. They get comfortable. The definitive signal of an impending market correction isn't a specific technical indicator or a sudden piece of bad news. It is the widespread disappearance of fear. When the average participant begins to treat financial markets like a guaranteed savings account, the structural foundation is already rotting. The human brain is wired to seek patterns and project the immediate past into the permanent future. If the market went up yesterday, and the day before, and the week before that, our internal survival mechanism assumes it will go up tomorrow. We stop looking for warning signs because our biology prefers comfort over truth. This is known as confirmation bias, and during a prolonged market expansion, it becomes an epidemic. To survive what comes next, a professional thinker must develop a counterintuitive mindset. When the room is screaming with excitement, you must look for the exits. Not because you are pessimistic, but because you understand that market movements are driven by a simple equation. When everyone has already bought, there is no one left to buy. The only direction remaining is down, the focus paradox. Why is it so difficult to maintain steady attention during a live trading session? You sit down at your desk with the best intentions. You promise yourself you will follow your plan, wait for your exact setup, and execute without hesitation. Yet, within an hour, you find yourself scrolling through social media, checking unrelated news, or worse, clicking buttons on a chart out of sheer boredom. This isn't a character flaw, it is a biological conflict. Your brain was designed for a physical world of immediate feedback. If our ancestors looked for food, they either found it or they didn't. Connection between action and outcome was direct. The market operates on an entirely different template. A framework of variable, unpredictable rewards. When you sit and wait for a setup, you are asking your brain to expend energy without any guarantee of a dopamine hit. The brain hates this. To save energy, it actively looks for distractions. It craves a micro reward, a text message, a headline, a quick 5-minute chart view on another asset. Every time you give in to that distraction, you break your mental discipline. You train your mind to seek novelty instead of consistency. The secret to professional focus isn't trying to force yourself to stare at a screen for 8 hours through sheer willpower. Willpower is a finite resource. It drains like a battery. Instead, the solution lies in designing an environment that removes choice entirely. If you have to choose to be disciplined every single second, you will eventually lose to decision fatigue. You must build a system where focus is the path of least resistance, delusion of certainty. Let's look closely at what actually happens inside your mind when you enter a trade. The moment your order is filled, your relationship with reality changes. Before you took the trade, you were an objective observer, analyzing data points. The moment you are in the trade, you become a stakeholder. You have skin in the game. Suddenly, your ego attaches itself to the outcome. The brain stops looking at the market objectively and starts looking for evidence that you are right. If the price moves against you, your mind discounts it as noise. If the price moves in your favor, even by a tiny fraction, your mind interprets it as a validation of your intelligence. This is the delusion of certainty. The market is an environment of pure probability. At any given moment, 1,000 different variables, an institutional sell order in London, an algorithmic rebalance in New York, a sudden headline in Tokyo, can completely alter the direction of price. None of these variables are under your control. Therefore, it is mathematically impossible to know for certain what the next trade will do. A professional accepts this uncertainty down to their core. A typical retail trader, however, merely tolerates it verbally while rejecting it emotionally. They expect every single trade to validate their ego. When a trade loses, they feel personally attacked by the market. They experience pain, and pain triggers defensive behavior. Revenge trading, moving stop losses, or freezing entirely. To win consistently, you must decouple your self-worth from the next outcome. The mechanism of self-sabotage. Why do smart, rational people do incredibly self-destructive things the moment they enter a financial environment? A surgeon who spends years training for precision will suddenly risk half their account on a single emotional trade. An engineer who relies entirely on data will ignore every rule in their playbook because they feel the market is about to turn. This happens because the modern human brain is still running on ancient survival software. In the wild, if a predator approached you, your amygdala, the emotional processing center of the brain, took over, bypassed the prefrontal cortex, the analytical part of your brain, to save your life. It didn't want you to analyze the predator. It wanted you to run or fight. In the market, losing position or a missed opportunity is perceived by your amygdala as a literal, physical threat to your survival. Dropping numbers on your screen register as a loss of resources, which our ancestors associated with starvation. Your brain triggers the fight or flight response. Your heart rate rises, your breathing becomes shallow, and your analytical mind goes offline. When you engage in revenge trading, you are in fight mode. You are trying to attack the market to get your resources back. When you freeze and refuse to take a loss, hoping the market will come back, you are in flight or freeze mode. You are hiding from the reality of the threat. The problem is that the market cannot be fought, and it cannot be hidden from. It is completely indifferent to your survival mechanisms, the architect of consistency. If willpower is unstable, and our natural biology is poorly adapted for the market, how does anyone achieve long-term consistency? The answer is found in the transition from an outcome-oriented mindset to a process-oriented identity. Think about a professional athlete. When a top-tier tennis player serves, they aren't thinking about winning the tournament trophy. They aren't even thinking about the score of the match. Their mind is entirely occupied by the mechanics of the serve, the ball toss, the knee bend, the racket angle, the follow-through. They trust that if the execution of the process is perfect, the outcome will take care of itself. In contrast, the amateur is obsessed with the score. They look at their profit and loss statement after every tick of the market. They calculate how much money they have made or lost every 30 seconds. By focusing on the outcome, which they cannot control, they completely neglect the process, which is the only thing they can control. To build a flawless routine, you must shift your focus entirely to execution metrics. Did you enter the trade exactly when your rules were met? Did you position size correctly according to your risk parameters? Did you manage the exit without emotional interference? If the answer to these questions is yes, then the trade was a success, regardless of whether it made money or lost money. Losing trade executed perfectly according to a valid plan is a professional success. Winning trade executed out of anger or luck is an amateur failure. Decoding the silent crash. Let's return to the concept of the market crash. Most people believe a crash happens suddenly, like a lightning strike. The crash is actually the final, visible stage of a long process of internal decay. Real warning signs occur weeks or months before the drop. They are visible to anyone who knows where to look. The first major sign is the decoupling of price from intrinsic reality. When assets begin rising simply because people expect them to rise tomorrow, the market has entered a purely psychological phase known as a speculative bubble. At this stage, the market is no longer pricing economic value. It is pricing human greed. The second sign is the arrival of the uninformed majority. When individuals who have never shown an interest in economics or finance suddenly start giving you asset recommendations, the distribution phase is nearing completion. Large, institutional players, the smart money, are quietly selling their positions to the enthusiastic, late-arriving public. They are exchanging real value for inflated capital. The third and most critical signal is the complete exhaustion of liquidity. Price requires a continuous influx of new money to sustain its upward trajectory. When everyone who can buy has already bought, the market stalls. It sits at an elevated level on incredibly thin volume. It looks stable, but it is actually highly fragile. All it takes is one small sell order to tip the balance, creating a cascade of automated stop losses and panic selling. Crash isn't an accident. It is a mathematical inevitability. Strategy of the daily ritual. To protect your mind from both the euphoria of winning streaks and the panic of market corrections, you must establish an unbreakable daily routine. This routine acts as a psychological armor, isolating your decision-making process from external chaos. The routine must begin long before you look at a live chart. The first step is internal calibration. When you wake up, your mind should not be flooded with market data or news opinions. Instead, you need a period of absolute neutrality. This is where you remind yourself of your primary objective: to execute a predefined edge with mathematical discipline, not to predict the future. The second step is a structural review. You look at your charts when the market is closed or quiet. You identify your key levels and your areas of interest based on historical data, not emotional bias. You write down your plan for the day. If the market does X, I will execute Y. If the market does Z, I will do nothing. By creating these conditional statements in advance, you eliminate the need to make stressful, real-time decisions during the heat of the session. The third step is execution isolation. When the market opens, you shut off all external noise. You turn off social media feeds, close chat rooms, and ignore financial news commentators. These platforms do not provide useful information. They provide emotional pollution. They trigger the fear of missing out or cause unearned anxiety. Your job is not to listen to the world. It is to observe the market structure and execute your blueprint. The work of a professional trader does not end when the closing bell rings. In fact, the most critical phase of the routine is just beginning, the post-session audit. This is where the gap between amateur and professional becomes an unbridgeable gulf. Most traders close their platform at the end of the day and either celebrate their profits or try to forget their losses. In both cases, they walk away with zero psychological growth. The master treats every trading day as a unique laboratory experiment, and their journal is the scientific record. During your evening review, you must document your mental state alongside your execution data. You need to ask yourself tough questions. Did I feel anxious during that third trade? Did I hesitate on my entry? Did I feel an urge to take profits early because I wanted to lock in a win? By documenting these emotional undercurrents, you begin to see patterns in your own psychology. Over time, you will notice that your worst trading errors don't happen randomly. They happen when specific emotional variables match up. Perhaps you overtrade on Thursdays after a stressful week, or you take excessive risk immediately after a major win. Once you map these psychological blind spots, you can design rules to prevent them. Turn your historical behavior into actionable data for self-correction. The ultimate shift. The journey to consistency is ultimately not a battle against the market, against algorithms, or against institutional manipulation. It is an internal restructuring. The market is simply a mirror, reflecting your deepest insecurities, your greed, and your hidden cognitive biases back at you in real time. To succeed, you must let go of the need to control the market. You cannot control it. You must accept that the market can do absolutely anything at any time, and that you do not need to know what will happen next to make money. You only need to know that your system has a positive expectancy over a large sample of trades, and that you possess the discipline to execute that sample without error. When you achieve this level of understanding, your relationship with trading changes completely. The anxiety disappears. The frantic search for the perfect indicator ends. You no longer view a losing trade as a failure, but simply as a routine cost of doing business. No different than a restaurant owner paying for inventory. You become steady, detached, and completely focused on the present moment. Build your routine. Protect your mind from the danger of your winning streaks. Watch the silent signals of human behavior before the market shifts. If you can master the landscape of your own mind, the market will eventually take care of itself.